Good morning, everybody. Welcome to the Flow Show. Nice quiet one to get me back in the swing of things. I love sitting down and seeing a bloodbath first thing in the morning. I hope you're all doing well and trading safe throughout this. It is very dangerous out there by the looks of things at the moment, so please trade cautiously. Morning, Kay. How you doing, mate?
Hey, good morning, Ryan. Welcome back. Yeah, we thought let's build a little party for your return and get you started on a nice and quiet footing in these markets. So we threw a little party. I hope you like it.
Yeah, I nearly turned around and took another week off. See, markets the way they are. But
we're going to call you the destabilizer or the destabilizer.
yeah, I've taken over from Blake, I think.
Yeah, I thought I did a pretty decent job when I was off, but this is
as the song goes, anything you can do, I can do better.
this is a week to remember for sure, and
Yes.
especially a Monday morning. It's been absolutely crazy out there. Huh?
Yeah, but I mean, just sitting down. When I go away, I do like to switch off as much as possible. So I've only briefly been looking at charts and prices or whatever. Otherwise, I get smacked around the back of the head by the missus. And so yeah, just a lot of catching up to do this morning for me, most definitely. But yeah, we'll have a look at what's going on. Try and make some sense of it.
Yeah, you know what? I mean, either you have a lot of catching up to do, or you don't catch up at all, and you're just situation as it is right now, and you say like, okay, what's next? There's two possibilities here. It's not like I want to tell anything special to our audience, but there are in fact two ways of looking at how the markets are right now. I mean, if you want to catch up on everything, of course we always do look at all those moves, but there is this other side of saying like, right, this has all happened now, so what's next?
Yeah, and it often can be a good thing just coming in with a fresh pair of eyes, seeing what's going on. That's one of the reasons why I've got the chart up that you can see there. Dollar yen takes me out of the intraday moves and shows me the longer term picture, and I'll get to see what's going on and where we're going and how things are going. But yeah, different perspectives as always. Right, let's get stuck into it and see what's going on. China had a big fall there as well amid all the moves. Look at that, 711 right down to that 38.2 FIB, but they're still fixing their rates at 713s. So they're keeping things slightly steady there, although now they're looking at the band on the other side, or the limit on the other side rather than the top side. They're looking at the downside now for their 2% limit. But anyway, following the dollar moves and the yen moves going on there, bit of a level, as I said, sitting here for dollar China. Over in Japan, we have had Finance Minister Suzuki and a few other officials waffling on. Obviously, we've seen this big, huge move in the Nikkei, part and parcel of what's going on there. If I can find it, where are we? Oh, lost it. Come on, where are you? There we go. So as you can see, big huge move there in the Nikkei today as well. So Suzuki saying he's watching stocks fall with strong interest, but says stock prices are determined by the market. He's also waffling on about watching FX moves with a high sense of urgency. So they're playing two sides of the volatility, shall we say. He played it to the upside and the same language on the downside. Also said that the F.A.C.E, which is the regulatory board in Japan, is also watching FX with a sense of urgency. So I dare say it, we could be looking for maybe some intervention on this side of the coin, Kay.
Yeah, mate, I mean, I woke up this morning and well, I saw other people, the comparisons that they make, but I had a very, very lively flashback of the, I think, 7 and 8 of October 1998, the Asian financial crisis, where we dropped like 22 big figures in the dollar yen in 2 sessions. We've taken more than 2 sessions, but the last 2 sessions did give us like 15 or so big figures, right? So I really think it's we're in we're in a situation now where they don't like it on the other side. And as a matter of fact, Hayashi also came out saying that he's monitoring financial situations domestic, which could be understood by a 10% or 10 or 15 or whatever percent drop in the Nikkei. And also abroad with a sense of urgency where all of a sudden the bonds are racing away and everything. So and he also said for currencies to move in a stable manner, reflecting fundamentals. This is really, I mean, those two are now on the warning side on the other side of the coin. And if I really can draw the comparison with what we saw in 1998, they could actually intervene to stabilize the whole thing. Now. There was this difference then is that probably the dollar was really getting sold very heavily against everything else as well. And this is not the picture that we have seen today. So we see similar in the Swiss, we see similar as in the yen. But if you look at the other currencies, it's not really yet. Yeah, the euro is what 1.5% higher compared to Friday early morning. But the rest, if you look at the rest of the dollars, that is not the same picture there. So I wonder if they would actually come in and well, why not buy some dollars back of what they sold around 160, you know?
Yeah, very much so. It is. This is a question. When they were jawbone and when yen was weakening, that's obviously something they need to keep a note of. But having these sort of moves in yen, this becomes a financial stability issue more than what the currency just being stronger or weaker. So if they do intervene, it's likely to be with that hat on that this is for financial stability than anything else. Because given how yen's reacted and weakened over years, they wouldn't mind some strength, but it's always about how that strength happens, and this is not how they want it to happen. Kay's made that mention, going back to ages past when seeing that crash. I've been saying before I went away, he's looking a bit like the 2022 move, although it's a bit speedier, but it's looking similar. So that's why I tend to look at the wider picture just to see where the levels might pop up. If this is going to be a continuing collapse, we're going to carve through these fibs, and then we've got something very, very wrong on our hands. But if we hold at these sort of levels, and again, you can't really trust your text that much, but you use them as a bit of a guide. If we hold down here, 139, 140s, we may have a similar situation to this, although this situation is not the same. Okay, there's different things going on, but we're getting because these prices. There's lots of things going on. Stocks, what's going on with semiconductors, Intel particularly. There's lots of moving parts in this, as we know.
There is a similarity though with 2020, indeed, because remember when the dollar yen turned around back in 2022, it was helped with a US weaker inflation data. So, and that's what I've been saying, like repeating, for the yen to materially strengthen and stay stronger, we're going to need some data in the rest of the world to come off. And that is exactly what we had also last week. We had a weaker manufacturing ISM, especially that employment subcomponent, which completely crashed away. We can actually say, even though services are more important somewhere, but it's the ISM, so it's that wider picture, which is it's a better picture than the S&P Global. We had that employment index dumping away, and then we had an increase in the unemployment rate on Friday. So this is the conditions for it to happen are there, and the same ones similar as in 2022 indeed. But then also we saw what happened in 2022. That was because of the rest barring inflation, and then inflation became sticky. Then we had this move up again. Here the picture may be slightly different in that fact that the employment now, the second part of the mandate, is now supporting these kind of moves. So I would be a bit careful just front running what may happen. I don't think that barring interventions also that we are going to see a massive rally on the dollar yen anymore for weeks to come. Let's put it that way. I mean, we can of course jump higher. Can we get back to 146, 750 maybe? Yeah, why not? But I mean, the move that we saw post 2022, we have to caution against it right now. Yeah.
Yeah, very much so. Very much so. I'll give my further thoughts once we got through the data, because and the other bits, because it's all going into the mixing pot today. So let's start looking at just a few bits of data as well, because it's some final PMIs coming in from around the globe. We see Australia, it's all services finals and other PMIs today. So service sector. So Aussie looking a bit weaker there, come missing expectations, lower than last month. Japan though had a decent number, but it's missed expectation, but still bounced back into expansion. So these are a little bit volatile at the moment, up and down for Japan in these PMIs. China as well, the Caixin Services PMI shown a good improvement there as well. So another reason why we're seeing a bit of strength in the yuan as well. Coming over into Europe, we had Spain out, and that saw a bit of a pullback. Was expected to be a bit of a minor pullback, but it fell to 53.9 from 56.8. Italy as well, pulling back. That made it 2-0 on the negatives. France saw a little bit of a bounce there to 50.1 from 49.6. Germany, though, on the services, also beating expectations, but dropping from last month. Although coming in green higher than expectations, still a drop from last month, 53.1. It's been a bit like that all the way through. The pan-Eurozone number, 51.9, coming in as expected, but confirming the drop. And the UK improving just a bit, 52.5 from the 52.4 flash number. Again, an increase over last month. So the UK sticking its neck out again in terms of economic performance. PPI in the Eurozone coming in at 0.5, a little hotter than expected on the month, year on year, not down as much as expected. Last week, obviously, we saw a few CPI numbers coming in on the upside of things. We've had BOE's Peel, one of the dissenters, shall we say, or one of the ones voting for staying on hold last week, saying it's a little quick to say inflation is down. Still a little way to go on inflation. We need to keep restrictive policy at least for a while, and we can't be complacent on inflation. We should not promise rates are going to move down further in a very short time. Obviously, last week the BOE pulled the trigger on a rate cut. Now, coming back to, yes, last week's NFPs, Friday's NFPs. And this is one of the things, obviously, looking back on, seeing what, doing the catch-up. If you take these numbers altogether, yes, it's mildly soft, okay, 114k, close to your 111k.
Yeah,
Yes.
I came pretty close. Well, I actually matched our winner's guess, who has also been for a few months betting on the 111k, right? So congrats to him, and I'll stick a little feather on my hat for that one.
Yeah.
But only a small one. I
wasn't too far away with my 1, 2, 3 either, only 9 away.
Yeah.
So good guesses all round. But
yeah, I was waiting. Well, I'm still 3k out. I remember the first competition we did. I was bang on the number, and since then I was miles off on any guess. So I'm going to
take them all you can, mate. Take them all you can. Now, obviously, there was a bit of surprise in the unemployment rate ticking up to 4.3. That got everyone hot under the collar. Part of that could be down to the participation rate rising a pip as well. So more people coming in to the jobs market but not being employed. So that adds to that unemployment rate. Wages came in softer. That's something definitely that the Fed are keeping an eye on. Lots of people looking at wages, many central banks looking at wages. They came in softer year on year, 3.6%. Any other time, yes, this is a soft report, okay? It's not a US economy collapsing report. It's a soft landing report, in my opinion. So to see the market flapping out the way it has after these data really is quite surprising. And it's getting me into that belief that maybe the market's going a lot too far. Well, it's blatantly obviously the market's going too far with its Fed expectations now. Before the NFP data, the market saw a 50% chance of 100 BPs of cuts in 2024. And swaps showed a 50% chance that one of the 2024 cuts would be a 50 basis point cut. So already the market was getting that way after last week's FOMC and some of the other data, ramping up rate cut bets. Now, after the NFP, expectations rose to over 60% chance the Fed will cut rates by 0.5 point in September. And that was up from 30% before the data. So pricing a over 60% chance of a 0.5 point cut in September. And this is just after the NFP data. Then that got ramped up to a 90% chance of a 0.5 point cut in September. Obviously, all the banks came out with their expectations and all running from one side of the boat to the other. Citi and JP Morgan see 50 BP cuts in September and November. Goldie's added a third 25 pip cut to its 2024 forecasts. TD sees now 75 pips of easing in 2024. They see 25 pips coming in SET, NOV and DEC. Barclays also adding a third 25 pip cut to its rate forecast. So the banks all getting very dovish on the Fed. Now, here's a bonkers one for you today. And you've got to take this with a bit of pinch of salt because the market's just extrapolating from some of these market moves and what it implies. So today, some of this pricing implied a 60% chance of a 25 basis point Fed cut within 1 week. So they're basically saying an inter-meeting rate cut. This is how panicky the market's getting. Market pricing is for over 125 basis points for the rest of the year for the Fed. So if you take the last few meetings, that's 250s and a 25. So they want 120 basis points of cuts, purely on the back of the Fed last week and the data last week and the NFP. In my opinion, that's just going too far. This data was mildly soft. It's not crash landing soft, but the market is now thinking that the US is heading for all sorts of problems. And we know the bearish lot, your zero hedges and everything, they will scream far louder than the bullish lot when it comes to this situation. So we are in the grip of a bit of panic, a bit of fear. I think it's going too far, but I'm not willing to stand in the way just yet because of the volatility. So just on that, Kay, 120 pips by the end of the year. Can you see it?
No. It's all part and parcel of what I said in the room as well. Somewhere, I mean, if you look at it post COVID, right, and during the COVID, we have really gone into accelerated, massively accelerated cycles everywhere, and the market also reacts as if those cycles are going to go continuously up and down, which is somewhere over exaggerated. The moves are all, and I said it. I mean, I've seen big moves on rates and expectations and the FOMC cutting and hike cycles. I've seen big moves, but the way this weather vane behavior is ongoing, this is something really new to me as well. But you know, it's not completely unsurprising, I'd say, because I've been saying that as well. I mean, put fewer and fewer human beings in charge of what bond markets and other markets should do. This is the result that you get. A machine And they all probably running on similar indicators to judge whether they want to be long short bonds, whether they want to be long short equities, for instance. And the FX is a derivative of it, really. And put fewer and fewer humans in place. This is the reaction that we get, because machines don't think whether it's going too far or not. They just hit markets. And so I think there's a combination here. On the other hand, I think some of the moves are warranted because the market was a bit lazy, let's put it that way, in pricing risk. We have seen those equity markets until the week before last were still going higher and higher. We saw the bond market relatively complacent as well, where Powell was already warning the markets against the uptick in unemployment would see them move. And now all of a sudden we are going the other way around. And I agree with you. We are probably swinging the pendulum too hard again until it until it breaks this time, it seems. Yeah, and so I am thinking that 125 is too early. Will they go into a meeting? I don't think so, unless they judge that the market is right. But then that means that they would increase the panic in the market if they cut into meeting. I think we are going to get comments, soothing comments probably, or smoothing comments probably. And also, there is a real risk that is building now, that if this dollar yen drops another 4 or 5 big figures when the US walks in, that we see the other side a bit of smoothing interventions as well. And that brings us straight away to what Ali was saying: is the Bank of Japan or the MOFA speculated? Not at all. Those interventions, they were because the yen was just too weak against everything. So they are not speculating, no worry. But yeah, I think we can expect at least comments, if not a bit of a smoothing intervention. That is all possible right now.
Yeah, and as Gavin says, if they did an intermarket cut, then the market is just going to shit the bed on that. There is no reason for an inter-meeting cut, because they only do such thing when it's a financial stability issue, and prices moving isn't a financial stability issue right now. Not at this level. Yields aren't collapsing. Yes, they're coming off, but there is nothing here that they should do an intermeeting cut on. They do that on shocks, not because of a mildly negative NFP report. Can they come out and talk about the market? Yes. I'm going to take the other side. I don't think they're not going to talk about the market, but they'll probably talk about the data like Goolsby has. They'll probably reference it from that side of things, that things aren't that bad. I mean, we've just seen a Q2 GDP of 2.8%, which beat expectations on the upside. By and large, we've come through earnings season not looking too bad. There is nothing in the fundamentals that screams the market should be crap in the bed on all this. But where do you want to try and catch that knife? Or, as traders amid this volatility, you've got to be very careful, And I'm going to give both myself and Kay a pat on the back. We were saying this when dollar yen was up at the 160s, how we were more bearish over the dollar and what was going on in the economy. And this is the market going far too bearish, running completely from one side of the boat to the other. And so now I'm going to look to be on the other side and say, right, when it goes too far, maybe I'll start trying to catch those knives. But judge the fundamentals against these price moves, and they don't add up at all. And that's my view of it anyway. But there's also been a knock on from all this. Markets now expect more than 90 basis points of cuts, nearly 100 basis points of cuts from the ECB this year. And that's up from 70% late on Friday and 50 basis points from the start of last week. So it's all having a knock-on effect. The market is pricing 42 basis points of easing in September. So that's nearly a 50 basis point cut from the ECB in September. And as I said, inflation went up in some of the countries last week. So again, it just doesn't match. Just doesn't match off. Talking of central bankers, Fed's Goolsby, he's been right out. I think he's out today. He was out last week doing the press rounds.
He wants to be the next in the next celebrity reality show.
He's going to be the next Bullard and Cash and Carry, I think, coming out every 5 minutes. He was saying that I've been saying for a long time we'd never want to overreact to 1 month's data. It's the job of the central bank is moving in a steady way. Fed policy is tight and restrictive. If we stay restrictive for too long, we have to think about the employment mandate. If unemployment goes higher than 4.1%, that's the kind of thing the Fed has to respond to. Well, it's gone to 4.3%. The through line of data doesn't change based on 1 month's number. We should cut rates if inflation and the jobs market continues to cool. So that's the type of language I think we're going to get from the Fed. Don't react to 1 month's data and things aren't that bad. Fed Barkin was out saying 114k jobs is not as good, but is still a reasonable number. Big rate cuts are more typical if the economy is rapidly weakening. So here we are, the pushback against big rate cuts. I've not overly caught up on the FOMC yet, Kay. What was the gist? What do you make the gist of that? Is that still part of this falling through, that the market is, just again getting overexcited?
Well, it did. The thing is, it was the he didn't fight back against much. He even said at one stage that they discussed the potential, well, not the possibility of cutting now, but they discussed rate cuts, but decided to keep everything still. So there was this admission of the discussion surrounding rate cuts. He also said that they were ready to support the system somewhere. That was one of the lines. So he kind of gave the market a bit of a green light to start pricing in lower yields as well. And then, of course, we had those two data later. But he didn't fight back against much. So I do think if you look at the combination of the Bank of Japan, the FOMC, and the data, yeah, I mean, it's a bit logic that the dollar got a bit of a knock on the head. It wasn't really extremely clear after the FOMC, but then once Thursday came around, the dollar got sold. Yeah, so that's the message of the FOMC is really, in simple terms, throwing the door wide open to September. They're probably going to do, and as he's been hammering since actually in May, if I recall well, on that ECB powwow, that they were looking at the other side of the mandate, employment, and he's been continuously repeating this, and now we are getting these employment data. So that is really throwing open the door wide open for September. But then the market was likely expecting him to use the August Jackson Hole to confirm it all, but everything came much earlier than the market expected. What I take away though as well from the FOMC, that it would not take a lot of worsening or of the employment market for them to go. So they really want the music continue to play as well for as soon as the employment market starts to show weakness. So now I think the market was clearly looking at, do we get a rate at 4% in the unemployment, which would have been taken as a pretty good report, but now we nudged up 0.2%, and 0.2% as such, as you were saying, is not a catastrophic number by any means. But it goes in line with what Powell was saying, that it won't take much to take them over the edge, and that's what the market really reacted to.
Yeah, very much so. So we'll get another NFP before the next FOMC. So that could be the icing on the cake. If that comes in as a 250 or 260, unemployment rate back to 4.1 or something, I'm going to laugh my nuts off. But I mean, just to come back, you always know when things are hitting the presses and whatever. I've just had a WhatsApp from a mate of mine who probably has never looked at a stock market in his life, asking, should we start to worry about Japan's Nikkei index dropping 12.4%? I've just literally had that on WhatsApp from one of my mates. So if you've got people like that asking about stock markets, we've gone too far, probably on one side. So anyway, question I wanted to ask you, Kate. We've had obviously this big fallout in the Nikkei, which is obviously transposed into everything else. We've got this Intel stuff going on as well, where it's fallen a chunk because they've announced a big cost-cutting plan and slashing jobs and whatever. So all semiconductors and Bubbles brought this up in our room are getting hosed. Given that we've had all this TSMC stuff going on in Japan, and I think maybe a big reason why people were buying into Japanese stocks, is that a part of this fallout, do you think? The Intel is hitting the semiconductors and the chip makers and whatnot?
Yeah, I mean, it's definitely part of it, Ryan. Definitely, and actually, Trump started that fire, right? But since then, it really didn't look back. Now, I think it's part of it. On the other hand, it's also part of it is get me out of all things yen right now, and there's been that big suit of followers when Buffett started to invest in Japan. Now, nearly 2 years ago, it was like September, October, I think, 2022, when he said, "Okay, I'm really diving into Japan now." And it's all that whole suit of followers now getting forced out, I reckon. And yeah, it's so part of it is those semiconductors. Also, I saw TSMC, and then one of the Japanese companies also looking at outside of Japan. So that may be that they made the local part of their business perhaps a bit less attractive. So it's all like different parts and pieces that make the engine running, that also all of a sudden flew off the engine, and the engine got stuck. So this is a big get me out of everything move. Will it get back? Oh, there's a possibility that it comes back, but again, to get back to the highs, it's going to be a big ask right now, because there's going to be less people, because some of them clearly must have got burned, right? Because otherwise you don't see such a very big move. Some of them must have been burned. So that's a part of the market that goes less or very with less amounts back into this market, right? So yeah, I don't think we are going to go back to the highs, but we can see levels, because I don't think that Buffett has given up the whole thing. But we've seen already this morning as well that he's been a bit clever in hedging it with a lot of US bills and everything. They are clever cookies over there. So as long as they get their 5, 7, 8% return per year out of the Japanese trading houses, they will still be relatively happy, I think. But yeah, the rest is purely, or not purely, but yeah, a big get me out of everything move, right?
Yeah, exactly, and that's what you got to be careful of, traders, because when the market's in that mood, it doesn't care about tech levels. If it has to sell stuff, get out stuff, it will get out, and you're seeing that in a lot of markets at the moment. There was a bit of geopolitical news, and I'm actually surprised this hasn't seen oil higher. This is the spat going on still with Israel and Iran after they took out one of the Hamas leaders. Iran seemingly looking to get involved and potentially striking back today. I haven't seen any headlines on that yet, but I would have thought oil would have been higher on the back of that, but it's not. We're seeing oil falling out of bed. Yeah, go on, mate.
It was the move just before there. That was the move higher. Was part of it. That was the move, and then all of a sudden, look at when it started to dive. That is on that manufacturing ISM number. It started to absolutely collapse, and I think a lot happened then on the combo of because the market bought into the geopolitical situation. It bought gold, it bought oil, and then all of a sudden the wheels came off.
Yeah, so that's not something that again, it's just something that you might think would be going one way, but it's actually going the other. And again, the fundamentals are speaking here. So the market is ignoring the fundamentals with that jobs number not being as bad as everyone's making it out to be. But here, as Kay says, here's oil saying that the market's far worse on the manufacturing numbers. So you've got two different areas, two different markets thinking two different things. So again, all becoming messy. And this oil move is one of the reasons why we're seeing, again, this divergence in the dollar trade. So dollar CAD having that spike up through 139s. It's back a bit now, but as you can see, this is seemingly now back on the oil bus. Although we are back under 139 at the moment, so we need to keep an eye on that one. But yeah, it's a bit of a mess following. We don't know what we're following. We're following the yen. We're following the dollar. It's all a bit all over the shop. So I'm probably going to need a day or two just to get my head around it all. Euro sterling, that took out the balance of my shorts into here. I've actually got a flat book at the moment. I'm not in anything. I got stopped out me dollar CAD short attempt. The balance of this short got stopped out 85.15. So I gave a little bit back on what I had left. Now I'm in a bit of wait and see mode to see what happens here. This one, Kate, is this just a bit of after reaction to the Bank of England? A bit of buy, or sell rumor buy that sort of thing.
Yeah, well, the after the Bank of England, because both Bailey and Peel said there was no guarantee on additional rate cuts. After the Bank of England, sterling was actually doing pretty okay because we had a bit of a move in sympathy, and that was still in the 84s, in the mid 84s, 84.45 up to 84.60 or so on the Bank of England in the euro sterling, and then it actually came back down to 84.20s. And it was all doing relatively okay until that US ISM hit, and then all of a sudden risk got a massive hit on the head. Yeah, I mean, it's all part of that big move of getting out of everything, and as we know by now, because I've been saying it and we've been saying it so often, sterling is a risk currency. So there is this move of get me out of there. But I think we are coming to levels because I've been saying that as well. It's fundamentally, if you look at this pair, is there anything that tells us that we should be selling sterling, particularly versus euro? I do not think so. I'm looking here, and I'm actually really very short, very small, sorry. Short in this right now because I want to try. There's a few things. There's this trend line. We have seen some sterling weakness into the top of the hour twice this morning already. Maybe some people still getting out of sterling, or there need to be some payments made for something, and I don't know. But to me, honestly, I don't see too much of a fundamental reason to be long euro sterling. So I'm trying the other side. We could look at a little bit of the range as well. If you go back on a bit longer time frame, around the 86s, there's been a bit of activity in the past as well. So yeah, I'm willing to give it a little bit of a go here and just try to see if it caps. We can see a bit of an extension there if the rest of the market still needs to get out of stuff, but we will see. I said I was going to look at 85.90, but I revised. Since I'm small, I'm going to really let it perhaps trade that 86, 86.20 if it want to, and then see what happens around there, you know.
Yeah, so this is looking. I'm just looking at the chart, at the other prices now. This is looking more like a cable going faster than the euro type move at the moment.
Yeah, that as well.
Yeah, so again, it's all trying to work out what's the driver. Is this being driven because the the UK is looking a bit crap and the data's collapsing? No, absolutely not. And the eurozone isn't exactly going great guns as well. So this looks like a speed thing between cable and the euro, which is actually quite calm at the moment. The euro. Right, Kay, I'm going to bet it over to you because I'm not fully up to speed with my charts and what I'm looking at and whatnot. So I'm going to punch it over to you. What I will say in the euro is we're maybe having a look up towards that 110. That might be something to tickle my fancy if we get up there, but I'm going to do a bit of judging first before we get there. So over to you, mate.
Yeah, okay. Sure. This is the picture that we have been watching for quite a while on that euro, right? We have tested it. We've gone a little bit above. So euro dollar, that wedge, we've gone just above it, all right? So of course this trend line is coming down. It used to be around 110, then 109.80. But this morning we have gone a little bit above, and now we are back below. So I think there's as we say, there's quite a few things going on. So you have to take all the levels today with a pinch of salt. But and I would say, look at this at the end of the day. If we're above or below, sorry, that could tell the market something. So you have the 109.60 and then stretch it to 109.80 here, that prior high. If that would go this little 20 pip zone, then we're probably going to trade into the 110s. But for the time being, we had the blip above and we are coming back below. So that is one area to potentially monitor for us over the rest of the day. I think on the lower side, we have to look at this 108.60.80 again. In between, one could argue just those low 109s could be a bit of a level, but really in this market where the market moves relatively fast, I'd say keep just a bit wider, your spectrum a bit wider, okay? The one where I'm a little worried, and that's where we talk about this sterling being a risk pair, is I need to go on tighter time frame. Cable on the it tried to rally on Friday and earlier this morning. So this is the move after the NFP, and then look, we went right just above this channel and came back. That is purely due to the risk factor in the sterling, okay? And now we're already back below this little crossroad that I had around 127.60. So that tells us that sterling is still undergoing the laws of risk, in my opinion. So we could widen this out a little bit now because we went a bit lower. Keep an eye on what's happening in the low 127s. We are not that far away. Anywhere from 127.25 down to 127 the figure, all right? This is probably going to be your intraday level where we need to stabilize if it goes through, maybe bad news as well. By the way, I mean, when we were talking and about those potential stabilizing or smoothing interventions, we can call it, on the yen, I was also thinking that tomorrow perhaps, or I don't know if they already did so. I didn't see any headlines. But we should be a bit careful with the Bank of Japan as well, where they could step into the ETFs and the Nikkei buying, okay? If they judge that the thing is going like too fast, they could really step in and start to support the market, okay? Because over the Bank of Japan, they weren't really specific about, unless I missed it, about their ETFs holdings, what they were going to do with it. But they could step in tomorrow and try to to start to buy Nikkei and ETFs. They can do it. Okay. So that's for the cable. Yeah. So I was watching this euro sterling here, this channel, and also the 78.6 of this move here. Let me just it is because we are on several levels here, all right? Also in the 90s. Okay, we are above the channel. The thing is, as I said, on the top of the hour, twice now on the hourly fixings, we have seen sterling being sold. So keep an eye on the next one, which is midday our time, and perhaps even the 1 p.m. London time to see if there's more to do, and then keep an eye on what's happening with risk, of course. But to me, this is starting to have done enough, really. So I'm slowly and with small amounts, because this market is pretty fast, so you have to monitor and manage your amounts as well. I'm going to see what this little range is top end range traffic zone is doing here on the euro sterling, because I don't think that fundamentally there's too much that should support a much weaker sterling versus euro, for instance. Gold, yeah, because a lot of people are looking at gold. Okay, I was out on Friday when this happened. I've been looking for headlines. I haven't seen the headlines. I was all quite nice. I was was a bit low gold going into it, so it was going higher. I did manage a little bit, as the people in the room know, around here of my longs, and then left in the 2470s, and then while I was driving, an hour later, I saw an alert saying that my trading stop was done around 2445. So that was a bit of a strange one. I also think that because if you look at the geopolitics, if you look at yields coming down, this is not your very logic move, right? But I don't think it's just part of get me out of everything move. Now, call it encouraging or not, but I think the fact that we are still above 24, I'm going to hang on to it, saying that it is still, in the global scheme of things, it's still relatively positive. Okay, if we start to break below, yeah, I know the clock, Brand, thank you. If we start to break below 24, then I would say that be a bit careful, especially if we start to go below those 23, 80, 90s. All right, I'm monitoring the situation right now. It's really going up and down relatively fast, but my overall personal feeling is that we should start to find support somewhere around here. Okay, get below 23, 85, 90. There's going to be more going on, and I'm going to get a little will need to reassess my view on this. As I also said, silver needs better data to be supportive. We got worse data. So what happened? It really went down quite a lot. So this really goes with my line of thinking, and why I have not been adding to anything silver also related, is because silver will need decent data to continue to go higher. And of course, it does not only require lower interest rates. All right, so this is your risk in stuff like silver. If the economic data get worse, this is going to underperform gold. All right. Last one that I'm going to look at today, we could be talking about everything, absolutely everything, but we don't just have the time. S&P, all right, same thing, and I've told you, I've warned you about this line. I've warned you about the shorter term 61.8 of this move that kept. All right, so now we had the capitulation, get me out of there, whatever move, and we are below the 5300, which was a level that I had, of which we bounced slightly, little bit on Friday. But then we really broken below, and now we are trading on the 61.8 of the last move higher. Okay, to me now, two levels. 5200 we're trading at here. This one, because we've broken, retested, and then did the last move higher. I think this trend line is good enough to monitor, which is around 50.60. Add the 78.6 of the move, which is around 50.80. There's your support area. And then just below, we have the 200 DMA, which will come in at 50.40. If that goes and we get a close below here, then the market will probably be in the next phase of panic, state of panic. Top side, yeah, there are a few levels in between 5,300, right? 5,300. If that goes above, and I don't know whether it's going to come on the back of comments or on the back of some action also, but if it goes back above, I would say that the biggest scare may be behind us. Is it going to go back up to the prior highs? Not straight away, because the market is a bit traumatized right now, and we are still trading slowing economic data, okay? But it could reach back up to, let's say, 5,400 or so. But I'd say really watch that 5,300, 50, 60, 80. And with that, Ryan, back over to you for today.
Yeah, thank you very much, mate. And that S&P chart was quite important, really, because it's going to tell you the difference. If you look at your fibs, it's going to tell you whether this is, again, just a bit of a pullback or if it's something that's going to be more. Anyway, last thing, watch the RBA tonight. They've been in a bit of a hawkish slant of late, potentially still looking at rate hikes. But I think given everything that's gone on in the last week or so, there's probably a risk that they pull that line out of their statement tonight. So it may sound a bit more dovish, but you never know with these guys. They could keep hike on the table in their thing. But the market expecting them to stay unchanged on that. But as I said, don't be surprised if they take a more dovish slant tonight. So Aussie could be, if we get a rally in the Aussie, that might be one to look at if they do that. Sorry, Kay, you were just about to say?
Yeah, the market actually priced it out on really small, lower CPIs last week. So the market completely priced out the RBA. I didn't show the Aussie because really we're running out of time. But watch 64.80 on the top side. That's the closest one.
Cool. Okay, mate, thank you very much. Thanks for holding the fort last week. And thank you to all the boys and girls for coming and watching us on the Flow Show. Been a long one today. So we'll say goodbye and we'll catch you all tomorrow. Have a good one.